Hey everyone, welcome to today's Explainer. I'm Steve. Look, today we are digging straight into a major midweek reality check on the tape. The market just threw a heavy punch back, and if you want a correct, razor-sharp analysis of what's actually happening out there, you've got to look past the mainstream noise. You have to track the real structural data. So we're cutting through the static today. No fluff, just the raw metrics. Let's open up the ledger and get to work.
Here is our flight plan for this briefing. We're going to cover the technical reset, the energy curve collapse, the yield pressure reality, the rotation battle, and finally, we'll lay out your professional trading directives.
All right, Section 1, the technical reset, a heavy punchback.
Now, the ledger doesn't lie, and right now we're looking at a whole lot of red across the board. The S&P 500 futures, that's the /ES contract, dropped over 0.5%. Brent crude took a heavier hit, down 1.62%. Spot gold actually fell back to hit a 2-month low, giving up nearly a full percent to close at $4,440.27. And Bitcoin took a massive beating, dropping over 2%. So yeah, it's a sea of red. But listen, you need to understand the underlying mechanics of why it's red before you just instinctively react.
Punching in on that exact S&P futures settlement level right here, 7,567. I want to be absolutely crystal clear on this point. This is not a panic. What we are looking at is a highly calculated institutional pause. You see, when the big money looks at an overextended index, they don't panic sell. No way. They mechanically take profits. They lock in their gains.
We're seeing a really stark divide in the market right now. You've got to contrast what's happening across these different asset classes. Over in Bitcoin, which is unraveling below key structural floors down to 65,216, we're seeing deep retail capitulation, just extreme fear. But in the broader equity market, that's disciplined, mechanical profit-taking. So don't make the mistake of confusing retail fear with institutional discipline.
Let's move on to Section 2, the energy curve collapse. This right here is the real story.
We're going to step away from those scary crypto numbers for a minute to look at the July Brent crude contract, that /BZN26. Look at how this thing has completely broken down. While there's a ton of massive front-month headline noise trying to whip the spot market around, the outer months on this curve are literally bleeding out premium. This downside expansion, that is a vital piece of getting your analysis correct today.
Lock in on that exact settlement number, 91.89. You can completely dismiss the headline noise you're hearing on the mainstream networks. The outer months are tracking lower, and that settlement at 91.89 is the actual data point that matters for your structural outlook.
So what does this all mean? Well, we call this a macro release valve. When oil falls like this, it essentially acts like a massive corporate tax cut. It dramatically expands profit margins, and it eases input costs for these companies. So here is the real twist. This oil drop, combined with a mild S&P pullback, is actually a really healthy mechanical backtest. It is definitely not a structural economic collapse. It's just the market taking a breath.
Section 3, yield pressure reality down at the fixed income desk.
So why the equity drop right now? The weight of interest rates finally caught up to risk assets. Take a look at these aggressive macro factors that are forcing the market's hand. Long-end U.S. Treasury yields caught a strong bid because, frankly, structural inflation concerns just refuse to back down. Core PCE is sticky. The U.S. dollar is strengthening. When the risk-free rate refuses to cool off, it forces a purely mechanical repricing of equity risk premiums. Sure, mega-cap tech can hide from borrowing costs for a little while on pure earnings power, but on a macro day like today, institutional managers are forced to defensively lock in those paper profits rather than try to fight a restrictive Federal Reserve.
Section 4, the rotation battle, turf war.
Capital is playing a very high-stakes game of defense right now. Let's break down the fight. On one side, the bulls are treating this as a totally routine backtest of a powerful structural uptrend. They're betting that those deep corporate margins, fueled by the drop in oil we were just talking about, will step in and buy this dip the second energy headlines stabilize. On the flip side, the bears are pointing directly to the extreme fear readings in crypto and the accelerating institutional exodus out of risk assets. They see this as absolute proof that sticky inflation is finally cracking the momentum trade. It's a total standoff.
Section 5, professional trading directives, execution.
Despite the drop, price action is holding right around our immediate line in the sand at 7,567. But the real story you need to be watching is that upward sloping 50-day exponential moving average. That is your ultimate structural anchor. As long as the 50 EMA holds on a weekly closing basis, the primary bull engine is structurally protected.
All right, here are your directives. Read them, memorize them. Number 1, trade the hard levels on your screen. Number 2, respect the 50-day EMA weekly close. 3, watch the /BZN26 outer months. If they track lower, that's your equity bull fuel right there. 4, stop guessing tops and bottoms. And 5, manage your position sizing based purely on the ledger. You have to stop letting macro ghosts scare you out of a winning tape.
I really want to leave you with this exact mindset. Let the numbers dictate your execution. The ledger doesn't wait for latecomers. Keep your eyes glued to those moving averages. Trade the actual numbers right in front of you and completely leave your emotions at the door. Professional trading on a highly volatile macro day like this requires absolute discipline.
You've got the data. You have the structural levels. You know the energy curve is bleeding out premium. The only question left is, are you ready for the morning bell, or are you going to let the macro ghosts scare you out of your position? Trust the ledger, execute your plan, and never, ever trade on fear. I'll see you out there.